It's being described as both a lifeline and a trap.
The idea is that the schemes allow people to pay for goods and services upfront with money they don't necessarily have.
A lot of people love it. They use it really well. They say it's good for their cash flow and managing their finances.
We see people coming in the door with 20 to 30 little loans. It's an absolute nightmare for them to get off that treadmill, and they're really fearful of getting out of buy now, pay later. They're really leaning on it as a lifeline or feel stuck to it because of the treadmill you get into where you're buying the essentials on it.
What we see all the time is that people take on a line of credit that is not affordable to them, and then over time that just blows out.
Alexia Russell here from The Detail, and today, buy now, pay later has been in New Zealand for about 8 years. It's still a relatively new product, but 1 million Kiwis use it. It's one that wasn't imagined when the country's credit card rules were drawn up, and so it manages to skirt around some of the protections and regulations in place for those. In 2024, there were changes to the rules to try and stop lending to people who didn't have much chance of paying their debts. Here's Alice Peacock, Newsroom's business reporter.
So from midway through 2024, legislation was tweaked so that buy now, pay later schemes were subject to consumer credit lending requirements under the Consumer Contracts and Consumer Finance Act, the same as banks and other lenders.
But a new report says more change is needed.
A report has found new regulations haven't stopped people from getting into problems with buy now, pay later services. The report by Consumer New Zealand and FinCap, with assistance from Victoria University, found some people are resorting to withdrawing money from their KiwiSaver accounts to clear buy now, pay later debt.
The report recommended tightening the rules further to get better protection for consumers.
If used properly, it's a good product and it can help smooth payment obligations. So if you can't afford that thing today, but you know that you've got money coming in and you can pay for it over a 6-week period or something, then it's a good product. But for some people, it does seem to be causing or contributing to them getting into unmanageable debt.
That's report author Victoria Stace, and I'll talk to her more a bit later in the podcast. But first, how does BNPL work?
When you sign up with Afterpay, you book, buy or collect the item or service you want today, and then pay for it in 4 instalments due every 2 weeks. This way, you get what you want without ever losing control of your money or providing personal bank details to anyone else.
Buy now, pay later basically enables instant gratification. It's great for paying for things like concert tickets where you don't want to miss out, but you can't quite stretch to the cost this payday. Companies such as Afterpay, which is the biggest of the 4 operating in New Zealand, make the bulk of their money from signing up merchants online or in shops. You can set up an account and register a debit or credit card against it. There are no interest payments, but if you miss a payment, there are penalties. Those charges are capped, and Afterpay will put a stop to further spending. If you don't have a good credit record, your spending can initially be limited to very small amounts. But as you show you can pay it off, those limits increase. Financial mentors and even some account holders, such as Ellie here, worry that it's being used for essentials such as food and groceries.
I think the nail in the coffin for me was seeing that Uber Eats now does Afterpay. And that there is something about if you're so hungry and you need food and you have to Afterpay it at $5 a week, it could be quite concerning.
Let's look at some of those concerns raised in the Consumer NZ FinCap report with Victoria Stace. She's a senior lecturer at Victoria University of Wellington, researching in areas of consumer credit and financial protection.
So the thing about buy now, pay later is when it first came along, the providers didn't have to do any form of credit checking or affordability assessment because the type of arrangement that it was not caught by the Credit Contracts and Consumer Finance Act. So the Credit Contracts and Consumer Finance Act regulates the provision of credit to consumers. If you go to a finance company, for example, they have to make certain disclosures, they have to lend responsibly, and so on. But because this particular product didn't have any interest component, they were outside the ambit of the Credit Contracts and Consumer Finance Act. So initially, for quite a few years, no credit checking was required. Some of the providers say they did it anyway, but legally it wasn't required. It wasn't until 2024, September 2024, that the government changed the law and said we will deem these types of arrangements to be consumer credit contracts, and that meant that the Credit Contracts and Consumer Finance Act started to apply to them, but in a modified way.
So basically a classic case of a new product that comes onto the market where legislation has not foreseen this situation. Yeah.
And not just in New Zealand, around the world. I mean, buy now, pay later has grown hugely in terms of the amount of sales and the revenue that it's generating for the providers over the last, 8 or so years, not just in New Zealand, but also in Australia, the UK, and various other countries. So all these regulators have been grappling with what do we do about this.
So if you use it well, it's probably better than a credit card because there's no credit card fees, no sneaky extras.
Exactly. Yep. If it's used well and you pay off your instalments without defaulting, it can work out better to do it this way because it's an interest-free arrangement. That's right.
It seems to me like it's a young person's thing. I mean, because you talk to the old people around, none of them have used it.
Yeah.
Is this right?
Absolutely.
Who's using these things and what are they buying with it?
Okay, so I don't know what they're buying, but I can tell you that it's definitely a young person's thing. So research across all of those jurisdictions that we looked at confirmed that the majority of people that use these types of products are aged between 18 and 34. So, for example, Australian research found that 60% of users were aged between 18 and 34. A New Zealand bit of research, that this is all before regulation in 2024, found that the highest percentage of arrears was in the 18 to 24-year-old age group, with the next highest age group being 25 to 29-year-olds. And research from the USA found that also young users, not only young users, but also people with very limited savings and generally low incomes. So there's obviously issues around the fact that there are people who are young users, given that young adults tend to lack financial experience, potentially more susceptible to taking on financial mistakes and potentially taking on more debt than they can handle.
I mean, it's also been mentioned that it's a lifeline for some people, but they keep racking up a series of small debts.
And I think that's probably the group that this particular survey is focusing in on, those people that see it as a lifeline and are using it because they might not have been able to access other forms of credit because of the more strict affordability assessment requirements.
So we're hearing that more people are being turned down, or we're seeing in the statistics actually that more people are being turned down for WINS grants. Is this taking its place?
Potentially. All I can tell you is what we've found from financial mentors telling us is that they look at, when a person comes in, they look at the types of debt that person has got. And on the debt schedules, buy now, pay later, you'd think it would, if the reforms that happened in 2024 to try and make it safer, you'd think that there'd be less buy now, pay later debt appearing on debt schedules. In fact, it's increasing. So that means more people have buy now, pay later as a proportion of their overall debt.
Victoria says there's unease about how much notice BNPL companies have to take of the credit checks they're doing.
The provider now just has to get a credit report on the person who's trying to sign up to buy now, pay later, and then they have to have a thing called a credit policy, which is an internal policy not available for anyone to see. That, I mean, you can't access it. Commerce Commission doesn't have it, for example, which explains what they do with that credit reporting information.
So even though they have to seek this information, they don't have to necessarily apply it to their customers.
Well, one would hope that they were. That's the intent, but there's no way of knowing whether that's actually happening. And the other issue there is that if somebody feels that they've been lent to in an unaffordable lending situation, it's quite difficult to challenge the process because the buy now, pay later provider at the moment just has to get a credit report, feed back certain information to the credit bureau, have a credit policy and then they've complied with the law, whereas other consumer lenders have to comply with these more high-level principles, i.e. lend in a way that's not going to cause significant financial hardship to the borrower. And there's a lot of nuances around what that means and what they have to do and so on. So there's more scope to find that a lender hasn't done that in the latter case.
But wouldn't it be a matter of self-preservation to not lend to someone who has no hope of paying it back?
That's a very interesting comment, and you'd think that's logically correct. What we found in the research was that some of the clients were particularly keen to keep their buy now, pay later line of what we regard as line of credit available, and thereby defaulting on other debts because they needed their buy now, pay later to pay for things. So they would find some other way of paying back the repayments that they couldn't afford, like borrow from friends or family, or default on credit cards, or basically go into default in some other area because they need their buy now, pay later.
It was this weird thing where I just kind of moved to Auckland. I was like, wow, I can have an Afterpay account and I can go and buy things. And it was very exciting as an 18-year-old.
Sometimes it was a way to preserve what little money I did have each week and make it easier to pay for it while still being able to pay for other things. And other times it's just habit, I guess.
So all we're saying is that it just needs a few more guardrails around it, particularly if you've got vulnerable consumers. And they could be beneficiaries, they could be people on low incomes, they could be people with, mental health issues, they could be students. So the starting point is you do an affordability assessment. Then you work out what's appropriate in particular situations.
Unsurprisingly, the people who run BNPL companies say they don't need extra regulations. Afterpay's Australian parent company is Block, and Michael Sadat is its international head of policy.
Well, actually, the previous Labor government decided to bring buy now, pay later within the regulation of the CCCFA, which is a long acronym, but it's the legislation in New Zealand that governs how consumer credit is regulated. Because previously, buy now, pay later was exempt from regulation because fundamentally the product doesn't charge interest. It's a very simple product, and existing credit laws hadn't anticipated a product like this. And so the previous Labor government did actually create a regulatory framework within that piece of legislation and brought the products within that legislation. But in doing so, it was recognised that buy now, pay later was much safer than credit cards. There's no interest, there's no compounding debt. When you don't pay off your account with us, we stop you from spending. And the spending limits are much lower than what you see with other products. And so because of that, the legislation reflects the way the product works, and we've got a slightly different regulatory framework, but it's all within the same legislation, and there's a number of very consistent consumer protections that apply across the board.
And what do you think of the recommendations made in the FinCap /Consumer NZ report?
We don't think that it's necessary for the New Zealand government to think about bringing in additional regulation. We think the evidence and the data should really drive any consideration of whether new regulation is required. And the data clearly shows that additional regulation, when it exists for other credit products, hasn't delivered better consumer outcomes. And so I think ultimately we don't want a situation where additional regulation comes in, brings additional cost that we have to bear, but also ultimately gets passed on to consumers. But also, we don't want a situation where, for example, it's harder for Kiwis to get access to a product like Afterpay, and that means that they have to go and find alternatives which are much more expensive, much less safe, and we just don't think that's a great outcome. So we think the current regulatory settings have struck the right balance. And actually, New Zealand was the first jurisdiction to go live with buy now, pay later regulation globally. And other countries are broadly following what New Zealand has done, because I think it's a clear example of how you can balance the need for good consumer protections with the need to promote innovation and foster safer consumer products.
Why do you think the watchdogs, if you like, have sort of branded buy now, pay later as a poverty trap?
I think financial mentors, they are experiencing consumers at the coalface who are in financial difficulty, and they would see consumers who have gotten themselves into trouble with all sorts of different products that they might have taken up. And I guess, that is something that informs their approach to these issues. But I guess fundamentally, when we're thinking about what policy settings should be in place, we do need to look across all consumers and understand what the overall consumer experience is. And that data is available through Centrix. They're New Zealand's leading credit bureau, and they've got data on all of these purchases. And we provide comprehensive credit reporting information to Centrix every month on every consumer that uses our product, and they can see what is happening across all consumers. And what they're reporting is actually that New Zealand consumers who are using buy now, pay later are in a healthy position. In fact, the latest data showed that if you look at the data on consumers that are up to 30 days late with their buy now, pay later purchases, the rate of consumers in that position has come down significantly from 12 months ago. So again, the data is important, and it's important to look at data for across the New Zealand population, rather than, I suppose, the situation that financial mentors are confronting, which is consumers who are ultimately in a really difficult position and of finding themselves that they need to get the support of a financial mentor.
Okay, how does Afterpay make its money? Is it sort of mostly from merchant fees?
That's right. We've really turned the model of consumer credit on its head by deriving most of our revenue from merchants rather than consumers. And as a result, it's really important for us that consumers are able to afford their purchases, because we don't allow consumers to spend if they're behind. And, because we only make our money from purchases when a consumer is successful, it's in our interest to make sure that consumers can afford their purchases.
So you've got those checks and balances there that stop people getting further and further into debt. There's no penalties on penalties on penalties.
That's right. We do charge a late fee, but the late fee is capped. And then once you reach the cap, then there's no additional charges that can be levied. The other thing that's important is that because of the new regulations that started a couple of years ago, we do credit checks on all of our customers when they're applying for a new account. And those credit checks mean that some customers will start with a slightly higher spending limit, and some customers might start with a lower spending limit. Our spending limits can start as low as $200, which is a really small amount of credit to be providing someone. But it does reflect the fact that we want to make sure that consumers can afford their purchases, and we're not providing consumers with a spending limit that is more than they can afford.
There's been criticism in this new report that some companies do credit checks but don't use them.
Yeah, I think that's a misunderstanding of how the regulatory framework works. We also saw that in the report. And what we would say is that the law actually requires us to firstly do the credit check, and we are doing the credit check. And actually, in addition, we have to participate in comprehensive credit reporting under the New Zealand regulations. But in doing the credit check, we absolutely need to use that information as part of our affordability assessment. It would be a very strange thing for the law to require you to do something like a credit check and then allow you to just ignore that information. That's absolutely not happening. And as I mentioned, with the information that we get from the credit check, some customers will have a really strong credit score and they will end up with a higher spending limit initially. Some customers might have a lower credit score and they will end up with a lower spending limit initially.
So it's almost like learning AI. The customers' limits are dictated by their success in paying off their bills, kind of thing.
Yeah, which is, I guess, another differentiator from traditional credit products like credit cards. With a credit card, you apply for a credit card and then you get given a spending limit of, say, $5,000 or $10,000 or even $20,000. And then you can do whatever you want with that spending limit. You can max out that credit card if you want to, and then you can make minimum repayments that take a very, very long time to pay down that debt, with interest rates of 20% or more. We don't operate like that. We are actually doing checks on customers every time they make a purchase. And if a customer is showing signs that they might be struggling, we reduce spending limits, we suspend accounts. There's a number of guardrails that are built into the product to ensure that consumers, don't end up in difficulty.
So have you got figures on how many consumers do end up in difficulty? Like sort of what proportion of your income, for example, comes from late fees compared to what you get from merchants?
Yeah, I mean, the vast majority of our revenue comes from merchants. I think an interesting data point here is, during the holiday season towards the end of last year, buy now, pay later was a pretty popular payment option for a lot of consumers who are trying to make their Christmas and holiday purchases. And what we've actually just published is data that shows that 97% of New Zealand customers who used Afterpay for Black Friday and Cyber Monday, which was a really popular weekend to be making your holiday purchases, 97% of those consumers paid off those purchases either early or on time, which again tells you that consumers are using the product in the way it was meant to be used. They're using it wisely. It's helping them budget for their purchases, and they're not getting into trouble. I think what's important here, though, is that if you look at the Centrix data, traditional credit products like personal loans, credit cards, and mortgages actually remain the primary drivers of hardship for New Zealanders. And this is clearly reflected in the data that Centrix just published a couple of weeks ago. And I think what you can, I guess, take from that is that people who have mortgages, people who have credit cards might also have an Afterpay account. But fundamentally, the reason that people are finding themselves in hardship is because of these products like mortgages and credit cards. And, they do remain the fundamental drivers of hardship for New Zealanders. And I guess for financial mentors, when they are helping a consumer who's finding themselves in trouble, they might find a consumer with a credit card, with a mortgage, with a personal loan, and they might also have an Afterpay account as well. But the Afterpay account is not the reason that consumer's in hardship. The reason that consumer's in hardship is actually because of these other products that are, much more significant in the financial life of that consumer.
So what will happen next? Alice Peacock contacted the office of the new Commerce Minister, Scott Simpson.
He came back and said that he found the report's findings concerning and that he'd be considering the recommendations along with advice from his officials. So I wouldn't say that there's anything directly in the short term that will come from this, but it's always good to know that the ministers are aware of findings and research that's going on in their space and are considering it when more policy is made.
That's it for today. The Detail is a newsroom production supported by RNZ and New Zealand On Air. This episode was engineered by Phil Benge and produced by Gwen McClure. Thanks to Victoria Stace, Michael Sadat, Alice Peacock and our 2 Afterpay users. I'm Alexia Russell. Mā te wā.